All right, class. In the last lectures, we talked about foreign exchange market. Today, we're going to talk about some other form of financial markets: money market, credit market, bond market, stock market. So, important thing is to understand those markets very well, then talk about international context. So before we talk about international money market, it's really important to understand what is a money market. So when we talk about money market, we broadly refer to a market where short-term debt instruments are traded. Short-term means the maturity of those debt instruments are less than 1 year. So any short-term debt instruments having a maturity of less than 1 year are called money market instruments. And the market where those instruments are traded are known as money market. So let's talk about some examples of money market instruments. So let's say commercial paper is a money market instrument. Big corporations issue commercial paper to raise short-term debt to operate their corporations. So commercial papers typically have a maturity of less than 1 year. Big corporations issue those commercial papers. So commercial paper is a money market instrument. The market in which commercial papers are traded is known as money market. US has a really rich money market industry. So now in these chapters, we're going to talk about a little bit outside of USA, because if we want to issue any debt from international money market, we have to go outside of USA. It could be Europe, could be Asia. So let's talk about a little bit of international money market. So we already know that corporations or governments sometimes can issue instruments for their short-term funds, right? And those are known as money market instruments. And they're going to issue those instruments different from their home currency, right? Why they will need those short-term debt? Maybe they need some money or funds to pay for imports, right? Now, if they want to issue any money market instruments, where they should go? They always prefer a country which one has lower interest rate than the US. So if borrowing outside is cheap than US, then it's always better to go international money market. And then if we can go somewhere to borrow where we expect the currency will depreciate, so it's better to go that country and borrow, because right now we'll get some international currency, we'll convert to US dollars. 3 months, 6 months later, when we're paying back those debts, if the international currency depreciate, we will pay less. So that's the benefit for us. So in short, if you want to borrow from international money market, we should prefer going somewhere where the interest rate is low and the currency of that country may depreciate in future. So as I already told you, there are established money market in Europe and Asia. I should say just go over this slide and book and just read about the history, like about the Asian and European money market. Now, how money market interest rate are basically set. So when you talk about any interest rate, we have to understand two factors: demand and supply. As we already told, money market is basically for short-term debt. So we have to understand the demand and supply for short-term fund. And that two competing forces will decide the interest rate for money market. So let's say MNCs are demanding a lot of short-term debt. On the other hand, individuals like us do not have a lot of savings. In that case, higher demand will lead to higher interest rate because the savings is lower. So in short, when you talk about how interest rates are set in money market, so we have to think about what is the demand of short-term funds, which is basically from MNCs and governments. What is the supply of short-term funds, which is basically from the savers group, like individuals, households, and their competing forces will decide the interest rate in the money market. So you can look at this graph. You can see that other than Brazil, money market interest rate is really, really low. That makes sense. That makes sense. One of the first reason is that duration or maturity of money market instruments are less than 1 year. So due to this lower maturity, the interest rate on money markets are really, really low. Now, when the interest rate on money market can change, so we have to understand the demand and supply factor, and that is the underlying thing for interest rate on money market. So in general, the money market interest rate among different countries are highly correlated, but we have to think about the competing forces, demand and supply. So let's say the overall economy global is really, really weak. What does it mean? If the economy is weak, MNC will have less business. If the MNC does less business, they will demand for less liquidity. So the corporations will need less amount of short-term fund. Demand should be lower. When demand is lower, all else constant, interest rate should be lower. On the other hand, let's say the economy is really, really strong. That means the MNC will do a lot of business. They will ask for a lot of short-term funds. So when the MNC will ask for a lot of short-term funds, everything held constant, the interest is gonna high. Again, we have to understand the basic demand and supply force. Demand is all about MNC ask for more money. When and why they should ask for more money? Reason is they are doing good business. They are growing, they need more money for further growth. So they will ask for more money. On the other hand, MNC are not doing good business. Overall economy is in recession. What is the implication? They will not ask for money, lower demand. So we have to understand the demand and supply force. Higher the demand, higher the interest rate. Higher the supply, lower the interest rate. Everything held constant. So for a given supply, higher the demand, higher the interest rate. For a given demand, higher the supply, lower interest rate. Some risk of international money market securities. So far, we have seen that interest rate on money market securities are really, really low, right? One of the reasons I already told you is maturity is less than 1 year. Another reason why interest rate on money market instruments are low, because of lower default risk, lower credit risk. Let me explain credit risk or default risk. So when any corporations borrow, the corporations has to make periodic interest payment and corporations has to make full loan repayment at the expiration, right? So this is corporations' responsibility to pay back all of these promised payments. When corporations fail to pay any promised interest or any promised loan value repayments, there is a risk of default, which is called default risk or credit risk. Higher the credit risk, the investor will ask for higher rate of return. Lower the credit risk, the investor will ask for lower rate of return. So basically the instruments, money market instruments have lower credit risk. So if when you think about the risk of money market instruments, they have lower credit risk. So that's why interest rate is in general low on the money market. But when you talk about international money market instruments, we from the US issuing debt in foreign country, there is a risk that is always there, which is called exchange rate risk. So while issuing any international money market instrument, we have to always think about the exchange rate risk. Now, this is all about money market. Now, sometimes MNCs may need intermediate term debt. So intermediate term means more than 1 year, less than 5 years. In those cases, sometimes they go for bank loans or bank credits. So you can think about when MNCs want to obtain medium-term funds through term loans from local finance institutions or the issuance of notes, that is more like a credit market. When they want to go abroad outside of local institutions, that is the international credit market. So international credit market, when they want to give any loans, they mostly follow LIBOR rate, London Interbank Offering Rate or London Interbank Offer Rate. LIBOR rate is a floating rate. So floating means every quarter they adjust the rate, they reset. So most of the credit market operates internationally. They actually follow LIBOR as their benchmark. And on top of that, based on that, they actually issue the credits. Sometimes MNC ask for big amount of money, which is not able to be lent by one individual bank or one corporations. In those cases, different banks, multiple banks work together, collaborate together, and combinedly they provide the loan. That is known as syndicated loans. So if the single bank is not able or is not willing to lend the amount needed or asked by the MNC, they will collaborate with multiple banks so that they can provide the loan all together. And that is known as syndicated loans. So it's nothing but similar to the credit market, similar to a single loan. The difference is it's a big size loans. One bank don't want to put a lot of money to one single borrower. That's why they want to collaborate with other banks. And that is called syndicated loans. Interest rate are basically charged similar way to single loan versus syndicated loans. So these are some acts. So I want you to just read those acts, like how those acts evolve. What is the implication of those acts? So if you have any questions, we can talk in the next class. So like look at like Single European Act, Basel Record, Basel II, Basel III. So Basel is more about capital requirement for the financial institution. So go and read those acts and their history. So moving on to bond market. So bond market is a little bit different from the credit market. So when you talk about bond, it's basically a long-term debt that a corporations issue for longer period of time. Most of the cases, bond could be have coupon payments, annual or semi-annual coupon payments. So what does it mean? So when the bond has any annual or semi-annual coupon payments, that means each 6 months or each 1 year, the corporations will pay certain percentage of money as a coupon to the investors. And they will keep paying that until the maturity. At expiration, the corporations that borrow will pay both the coupon and the full value of the bond. So this is known as coupon bond. Coupon could be semi-annual payment or annual payment. Sometimes bond have a couple of features. Let's say bond have convertible features. So when the bond has convertible features, that means at expiration, this bond can be converted to stocks. So let's say there is a bond that is issued for $1,000, 10 years of maturity, and it comes with the convertible provision that at expiration, the investor could decide whether they want the bond money back or whether they want to convert to stock. If they want to convert to stock, that should be 1:10 ratio, which means for one bond, they will get 10 stocks. At expiration, bond holders or the investors can decide what they want to do. Sometimes it comes with callable provision. Callable provision means the borrowers, the financial institutions, if they want, they can redeem the bond before the maturity. Same example, the bond is issued at $1,000 for 10 years. So that means bond will be repaid at the end of 10 years, right? But sometimes borrowers, they want to call the back. They want to redeem the bond before 10 years. Could be the reason? The reason could be market interest rate is lower. So they can issue bonds at a lower rate, and with that money, they can redeem the existing bonds. So this is called callable bonds. If the bond has any provisions like callability, the borrower can call the bonds before the expiration. Now, euro bonds. What is the euro bonds? So don't get confused about like euro bonds or something. Euro, if it comes before any financial instruments. So the word euro means if people in USA issue some bonds outside in USA in US dominated currency, that is kind of euro bonds. So you can think about it's dominated in a currency in the country than something else. So we are going to issue a bond in UK. So the currency for UK is not dollar, right? But we're issuing a bond in UK in dollar. So that's more like a euro bond because it is issuing in a country at a different currency that that country use. That's kind of Eurobond. So the market for international bond is basically it's traded between the underwriters and dealers mostly. So this is all about the bond. So let me know if you have any questions. Similar to money market interest rate, if you talk about the interest rate on the bond market, same two force, demand and supply. So we have to understand the demand for long-term debt. So basically, if the MNCs want money for long-term debt versus the supply for long-term debt, if the MNCs wanted, if the investors want to save more money, so two force again, demand, supply. If MNC demand a lot of money with longer maturity, that is higher demand, everything else constant, interest will go up. If MNC has a constant demand, investors, savers like individuals, households have more savings, more supply. With a constant demand, interest rate will go down. Everything depends on aggregate demand and supply. MNC could demand more and less depending on how the economy is working. If the economy is strong, they'll ask for more money because they have business. They need money for growth. Economy is weak, they don't have more money. So similarly, we have to think about the interest rate, how interest rate is determined in the money market, similar forces in the bond market. Risk of international bonds other than exchange rate. So any kind of international security has in exchange rate risk. So other than exchange rate, what are some additional risk? Interest rate risk. So basically, when a bond is issued, they actually decide at what rate the bond should be issued. And bond price are inversely related to interest rate. If interest rate goes up, bond price goes down. If interest rate goes down, bond price goes up. So if a bond is issued today for next 10 years, and within that 10 years, if interest rate fluctuates, that will affect your bond price. If interest rate goes up from the interest rate the bond was originally issued, your bond price will go down from the price it was originally issued. So that is called interest rate risk. Because of interest rate fluctuations, bond prices are affected in the other way, like negatively. Higher interest rate, lower bond price. Lower interest rate, higher bond price. So that's why all bonds, even if international or domestic, have interest rate risk, because the interest rate goes up and you will lose the bond value. Exchange rate is common for any kind of financial assets. Liquidity risk. Sometimes international bond markets are not liquid. Even sometimes domestic bond markets are not liquid. What does it mean? If Apple issue a bond today, and being an investor, I bought the bond from Apple, 3 years later, 4 years later, I want to sell my bond. I want to sell my bond and get the cash back in the secondary market, because I cannot sell it back to the Apple because this is issued for 10 years. Between the 10 years, if I want to sell it in the secondary market, I may not find a buyer who is willing to buy my bond at a fair value. So when you talk about liquidity risk, basic definition, liquidity risk means if we cannot convert our asset into cash quickly without losing a significant amount of the value. That is liquidity risk. So if we are not able to convert our asset into cash very quickly, and if we are not able to convert our cash without losing significant amount of the value, there is a liquidity risk. So every bonds basically have some liquidity risk, because if I buy a bond today, which has 10 years of maturity, maybe in 5 years, I may not find a buyer that wants to buy my bond. Even if I find a buyer, the buyer would not be willing to pay me the fair value. So I'm losing some value. So that is a liquidity risk. And every bonds have a liquidity risk. The longer the maturity, higher the liquidity risk. Credit risk. We already explained. If any MNC issue any bond, periodically it has to pay coupon, periodically it has to pay principal. If the MNC fail to pay that, it's actually failing to pay all those promised payments, right? So it's a default. So every bonds comes with default or credit risk. So these are the 4 risk factors. If you want to invest in international bond market, you should understand these risk factors. So I feel like this may be tough for you to understand. If you have any questions, feel free to ask me in the next class. We can explain. So look at those international crises. So if there's a crisis in the other countries, what is the impact? So if any crisis in any countries, there is always a contagion effect. So contagion means something contagious like COVID. If I got COVID, I hang out with you, you may got COVID. So something contagious can spread. So let's talk about what happens during 2010 and 2011 in Europe, mostly in Greece and Portugal. So most of the countries, they actually fail to pay their sovereign debt due to poor economy. So if any countries have a poor economy, that means it should not be able to import, right, from other countries. It is affecting the international trade. If any country is having a really, really poor economy, maybe investors from outside should not be willing to do a lot of direct foreign investments there, right? So this is contagion effect. So if any country is going through an economic crisis or any political risk or any sort of crisis, and that economy is not doing well, this is not only confined to that country. Because if that country is not doing well, that country is not also participating in international trade, international business. Foreign investors is not willing to put their investment on that country. So this is called contagion effect. Problem from one country is spread others and affect the other country too. Stock market. So you always know stock market, right? So basically it's a ownership claim. If any corporations issue any stock, excuse me, you will get the ownership claim and you will get the dividend, you will share the growth, you'll share the profit, right? So if we talk about international stock market, there are mostly like Yankee stock offerings or ADR. So when you talk about Yankee stock offerings, it's basically non-US corporations. If they need a lot of money, they can issue stock in United States. Anyone from Europe, anyone from China, Australia, if they issue stock in US, that is a Yankee stock offering. ADR. ADR is more like a certificates. It's not a real stock offering. It's more like a certificates that actually represents ownership of a certain stock. Any corporations who wants to issue certificates in the US and get the money by giving a claim on the stock they have, that is more like an ADR. So you can also think about ADR is all about when stocks of any European countries are deposited in the US, and from that deposit, from that bundle, they're creating a new certificate, and which is issued to get the money, that is an ADR. There is an electric vehicle company in China, which is known as Neo Incorporations. So they have ADRs in US. So most of the cases, ADRs are not new stock issuance. They already issued stocks in their home country. Using that already issued stock, they're creating a new certificate, and that certificate, they're raising some money. So it's not a completely new stock issuance. On the other hand, Yankee stock offerings are mostly new stock issuance. Any country or any company from outside the US, they can come in here and they can completely issue new stocks. So these are like Yankee and ADRs. So most of the corporations that's not from US, outside of US, want to issue stocks here, they're mostly listed in NYSE and NASDAQ. If they're listed in NYSE and NASDAQ, they have to follow all the rules and regulation by SEC of USA, government of USA. And that's why any country-specific rules and regulations can affect new stock issuance from the outsiders. Because in 2002, there is a new act, which is Sarbanes-Oxley Act, or SOX, on foreign stock listing. SOX actually require a lot of disclosure from the investors, corporation side, a lot of disclosure from the corporation side. So due to that requirement, lot of companies, they don't want to list it in US anymore. They rather prefer to go Europe, Australia, or somewhere else. So any rule, any law, any act which is for foreign companies may need more disclosure or more strict policies, something like that, that could affect foreign companies to get listed here. Foreign companies may choose to go somewhere else. So these are some big stock markets outside of USA. So yeah, so that's it. Just go over this slide. Yeah, go over these slides and that's all. So read these lectures, watch this video, read the books. And if you have any questions, I'll have some time on the next class so we can go over it. So that's all. Thank you.